we felt it was really relevant given where um, the market activity over the last week or two, particularly after the market hit some June lows, just to kind of give you an update of what's going on, what we're seeing, impacts, possible path forward from here. So again, we did want to welcome you. We encourage you, if you have questions. Of course, this is being recorded, so we just want to let everybody know it is recorded and you can get a copy of it. But if you have questions, please just use the chat. Lauren will be monitoring that throughout the presentation, and we will, if it's relevant to what we're talking about, we'll stop the presentation and address that. Otherwise, we'll leave it to the end for Q&A. Okay. So we do have some disclosures that we have to provide. We're not going to read them, but we do have to provide these disclosures when we give a webinar. And there we are. That's all of us. So actually, we have two others that weren't in that photo, but always good to put a face to a name. If you haven't seen some of the people on our team, that's everybody there. And then, of course, everybody pretty much knows that, our goal is, as a fiduciary, is to provide advice, provide services that are always in our clients' best interest. We just always like to highlight that, and to make sure, that you understand when we create plans, and whether it's a financial plan or an investment plan, we always take into consideration the tax impact for that. We think that they're integrated completely into to every financial plan. So that's kind of one of the things I think that separates us from some of our contemporaries. So we could move forward, Lauren. Okay, I don't know. Okay, so here we go. So this is generally our agenda for today. And our goal was really to have a conversation, really between Tim and myself. A lot of the things that we talk about on a daily basis, that we're not always picking up the phone or sending emails to let all of know what's in our thoughts. But what we wanted to do was, through this webinar, have that conversation and let you know how we got here. Some of the facts around exactly what's going on in the markets, both the bond market and the stock market, but also to a larger extent, how about the employment market? How about the market for the US dollar? What's going on there, and markets around the world? Like, why are we here? How we got here? And then really what our base case is, moving forward. So some of this information is going to be, anecdotal. I love to use analogies, in discussions to make complex financial planning matters seem a little bit more understandable. I think that helps. But we're going to be technical. So there's going to be some percentages and rates of returns. So a lot of subjective information as well, kind of what our thoughts are, on analyzing the data and how we're going to move forward. I think it's always a great reminder, even when we were having discussions with you back in the fall and the markets were, climbing that wall worry and charging forward, and in December hitting all-time highs, to understand, even though we're at the opposite time right now, markets are fickle. They are unpredictable. Lots of times it feels like a roller coaster up and down, and that can be exciting, but it can also be terrifying. But what we want to do for you is to make you understand it shouldn't be terrifying. So we want to give you the information, at least from the market's perspective and our perspective, to tell you why, despite the roller coaster that we're on, this doesn't have to be a terrifying and shouldn't be a terrifying moment, although we understand that emotion. So I think it's important that we allay some fears. First and foremost, the current market decline, the decline in prices of stocks and bonds, is not going to impact your long-term plan. This is a scenario that when we design our plans, both the financial plan and the investment plan for your portfolios, um, we account for this scenario along with thousands of other possibilities. You may have heard us use the term Monte Carlo simulation, um, probability of success, but this is just one of those moments in time among thousands of other, market outcomes. So that's important to remember. If you're in retirement or near retirement, the noise and the market price declines generally will not impact the income that your portfolio is producing and the ability to withdraw in retirement. We talk a lot about your standard of living that you're used to, and the income from your portfolio is designed to keep up with that standard of living. But we've designed the portfolios to ensure that your withdrawal ability will not change even in market environments like this. There are obviously other external factors that could change that, but just the market's repricing of asset values is not going to change the income that's being produced. Most of that is locked in. That's why we refer to it oftentimes as fixed income, that it's not going to change. In fact, the market now is creating opportunities to lock in higher interest rates at really good prices that will benefit your portfolio in retirement for a long time. Some of us, or some of you may have heard us talk about, and we've sent out a number of newsletters and conversation pieces and in our meetings, the Series I savings bond that's yielding 9.62%. That's just one example of a great opportunity that a distressed market can provide, higher interest rates to lock those in. And then if you're in the accumulation phase of your life, whether you're 21 and you just started your current job, or you're 55 and 5 or 10 years away from retirement, you're still accumulating. So you're trying to save as much as you can. You're trying to maximize your 401k, 403b, thrift savings plan. That pre-retirement accumulation phase, this is one of those great opportunities where you have the ability to purchase more assets, more shares of stock, more shares of mutual funds, ETFs, more individual bonds at discounted values. And that will benefit your portfolio, your income, your retirement for many, many years. So it's always like to say that, the market gets it wrong in the short term, and that gives us opportunities to buy assets at significantly discounted values. We believe we're in one of those periods right now. So next slide. Yep. So I think one of the other things you hear us talk a lot about is noise. And the noise comes from lots of different places. It comes from social media. It comes from the news. It comes from friends and family talking at a cookout or a Sunday dinner, that create a lot of fear and uncertainty. So terms like recession, inflation. How many of you know that the 30-year mortgage rate is now over 7.5% today? How many know that interest rates have gone up 300 basis points in the year? Concerns about unemployment. Energy prices, fuel costs have come down here recently, but oil continues to go higher. Why? Well, we've had a significant release of the Strategic Petroleum Reserve. It's created more supply on the market. Gas prices come down, but that's not something permanent. The market does move around. It is very, very fluid. The U.S. dollar is heading higher almost, it seems like every single day, and we're hearing stories of people flying from New York over to Paris to buy goods, handbags, and take luxury vacations and things because the U.S. dollar is so strong, which makes the purchasing price overseas that much greater. The supply chain, we still know about constraints there, not only supply chain for goods and services, but also for employers. I still drive down many of the roads that I travel and see help wanted signs. This is a lot of noise. It's a lot of things for any one of us to digest. And the stock market, the biggest market of them all, is taking all of this information and it's trying to just dissect it simultaneously. And that's where you get kind of the market environment that we're in right now, with a lot of with the declines year to date. So when we go to the next slide, I think these are the facts, and here's one of those analogies where I always like to use. If you take a snapshot in time, if we take a picture today, obviously tomorrow I've aged a year, and tomorrow I've aged a day, and I'm older than I was 2 days ago. And the market's the same way. When you take that snapshot, it is just a picture in time, being very fluid. It's moving around all the time. So we hear part of the noise is the stock market's down. But what does this mean, and what is the perspective? So on our left picture, we have the actual year-to-date declines through Friday through 9/30/2022. And the bond market, the conservative, what you would hear, safe place to put your money, is actually down 14%. Well, why is that? That's because interest rates have been going up, so bond principal goes down. Now, one of the strategies that we employ is we like to buy individual bonds, and that helps protect our clients, from that volatility. But nonetheless, the bond market is down 14%. Your value stocks, just think of those as dividend paying stocks, maybe your IBMs of the world, down almost 17%. The Dow, the 30 Dow stocks, down 21%. The S&P 500, one of the broadest measures of blue chip companies in the world, down 25%. The growth index, so your technology and smaller growth, highly growth, oriented companies, down almost 31%. The NASDAQ stock market, highly tech oriented, your Microsofts, your Zoom video, down over 32%. So significant declines at that snapshot on 9/30/2022. The velocity of decline, the picture to your right, is the fourth worst in history. It's one of the fastest declines in all of these measures over the last 100 years. So 2022, the S&P 500 down 24.8%. The Great Depression, 1931, down almost 29% year to date through 9/30. 1974, the oil crisis, oil embargoes, the creation of OPEC, creating high inflation and a recession in the U.S., down 32% year to date. In 2002, not that long ago, the war in Afghanistan and Iraq started, down almost 30%, 29.7%. But 1 year after, it's a completely different picture. Now, in 1932, after the Great Depression, the market was still down another 8%. We'll talk a little bit about that. But in 1975, the market was up 37%. In 2003, 1 year later, the market was up 29%. So taking snapshots at different periods of time have a completely different outlook. And I think that's one of the reasons, I say we shouldn't be terrified at where the market is currently priced. It's creating opportunities, but 1 year later, it's a completely different picture. Okay, so we just go to the next slide, Lauren. So we don't have the crystal ball. We've talked about this. You hear us often say this, and no one does. No one has the crystal ball to know for sure. The average rebound of those 3 years was 19.3% a year later. The average rebound for the 2 positive years was 33%. So where could we possibly go from here? Well, we possibly could go down another 8%. I don't think that's likely, but we could. But we also could rise from a market of about 3,600 as measured by the S&P 500 to maybe 4,300 or 4,800. That would be the average of the other 2 positive years. And Tim's going to talk a little bit about some of the makeup of that and why we think that's possible. But anecdotally, bear markets don't last forever, and there's typically an inflection point that causes the turnaround. Um, but the reality is no one knows for sure. And so what we like to say is stocks and bonds are another asset in your portfolio and of your net worth. And if we were to consider a similar decline of 20 to 30% of your home value, that's not going to cause you to sell your home. You might not be happy with it. You might not even be terrified if it goes down 20 to 30%. And so we don't think we should sell, your stocks and bonds as well, just because there's a decline, especially if that home was what we like to call a money machine. And that's what stocks and bonds are. They're money machines. They provide dividends, earnings, share buybacks, interest on a monthly basis, quarterly basis, semi-annual and annual basis. And so if you had a home that was down 20 to 30% and that was paying you income in the form of rent, you're still getting a return on your money despite that decline, and you certainly wouldn't sell it because of that decline. And stocks and bonds work the same way. Okay, so I think we go to the next slide, and Tim's going to give a little bit of the technical side of these things.
Yeah, so I wanted to go over how we got here. I want to remind everybody that the stock market is forward-looking. It's always looking out to the forward to try to figure out, what kind of valuation it should put on the underlying assets inside the market. So we're looking at a slide here as of January 1st of 2022, and the S&P 500 was at 4,779. Inside of the S&P 500 or 500 individual stocks that each of them have their own earnings estimates and so forth, and own earnings, own revenue. So the technicians like to get out there and figure out what that total is. So back on January 1st, the average estimate for 2022 was about $250 per share for the S&P 500. It represented about a 19.8% growth over 2021, and everything was pretty rosy back then. Interest rates were low, everything was pretty good. We just came off a big 2021 year, and we entered 2022 with a little bit of momentum and a pretty good outlook. Off to the left there's an earnings multiple there, and it says 20. So the investment industry likes to apply a multiple to those earnings to kind of try to figure out where the S&P might get to, based on earnings and based on a multiple. The historical average is about 16 times. But given the rosy outlook, given the clarity we had, given the low interest rate environment, et cetera, we were getting a premium to historical market averages. So anyways, people said it was maybe 20, maybe it was 18, maybe it was 22. So we're just going to operate like it was on a 20 multiple. So if we're considering a 20 multiple on the earnings, and the earnings were $250, which was about a 20% increase, you can see that we get up to that middle one there is about $250 per share in earnings, which was the estimate, and putting a 20 multiple on it would say, hey, we're going to get up to about 5,004, a little over 5,000 on the S&P by the end of the year, which represents a 4.7% increase. Keep in mind there's dividends on top of this, so you might get up towards 6.5%, 7% for the year, which would be probably a slightly less than average return, which is normally in the 8 to 10% range, but still pretty good, especially given the year we had before. If you took a higher rate of 25% and said, well, maybe these earnings can grow to $260 a share, that would imply a market valuation of $5,200, or about a 9% return. Add in the interest and dividends, you get up to about 11%, which would be an above average rate for the year. And then if you just said, well, I don't think we're going to do all that great, we're not going to get up to 250, maybe we only do 15% growth, so we end up at $240 per share, a pretty flat market around 4,800, maybe add in the interest dividends, we'll make a couple of percent. So that's kind of what we were looking at the beginning of the year, based on all the information we have. Now let's fast forward to where we are now. So as of 9/30, obviously the S&P 500 has dropped to 3,585 through Friday. represents about a 24.8% decrease, as we discussed earlier. You can see that the earnings estimates have dropped to about 220. They were 250. They've dropped about 12% since that 250 down to 220. Now that earnings estimate will solidify the deeper and deeper we get into 2022. So we've obviously had 6 good months of hard data that we can hard code in there. You know, the March quarter, the June quarter. Now we've got the September quarter. We'll be getting a lot of data coming in October and early November, which will help solidify that for the year. But it's looking like we're to come in around 220 for the year. Now off to the left, you can see I've now contracted that earnings multiple. We were at 20. Things were rosy. Interest rates were low. Investment community was thinking 20, 22 times. Now the investment community is thinking, oh, maybe it's only worth 18 times because our clarity is not as good and the interest rates are higher. Or maybe it's only 16. Some people are down to say, oh no, we got to go down to 14. So let's just assume that the market is looking at the historical average of about 16 times. And let's suppose, and if you see my base cases and so forth are now predicting what 2023 growth will be. So if we're assuming it's 220 for the year, what if we do minus 5% from here next year? If minus 5%, that means 220 will drop down to 209. Yeah, the S&P 500 will probably likely fall further to 3344, and we'll have a negative 7% return next year. Again, that's assuming a negative 5% growth from here. Now, what if we get a positive 5%? That'd be the middle column. Now we've got estimates that are $231, 16 multiple gets us to $36.96, a 3% return from here, and plus the interest and dividends, gets you up to about 5%. What if we grew 10% from here? $242. We get up to a valuation of $38.72. We get an 8% return. That's much more normal. What if that, I don't have a slide for this, but what if that earnings multiple, because interest rates maybe are coming back down, now grows to maybe 18 times or 20 times, or maybe the 10% is actually 12%. You can see that, as Tom said earlier, we don't have a crystal ball, but these are the numbers we kind of look at to kind of figure out what is the value of the market. And a lot has to do with that multiple, and a lot more has to do with the earnings and the growth. The higher the growth, the more stability, the more clarity, the idea that, hey, maybe we've reached the top of our interest rate cycle and interest rates will maybe flatten off here and start to come back down. That will make the investment community a little bit more at ease to say, hey, where should I put my money today? Should I go buy a 4% 2-year treasury? Should I buy a 3.8% 10-year treasury and lock it in for a long time? Should I go buy some stocks that have some of them have dividend yields of 4, 5, 6%? And are in pretty good shape. So those are the kinds of things we're looking at. We believe that everybody, the investment community, the individual companies, they're all trying to get better. They're all trying. We're seeing cost cuts. I forget who we saw today. Somebody was cutting jobs. We've seen FedEx recently announce some things where they're trying to fix their costs, and they've actually increased their what they're sending packages, the rate for sending packages. We've seen Target come out and say, hey, we've got high inventories. That was last spring. They've been working through those inventories. So all of these things are working to deal with the current environment, which really turned quickly from pretty much June until September. There's a lot of anecdotal evidence that things got pretty bad then. So you've got all these companies working to get better, working to right size their business, and we have the investment community trying to reprice and think about where their assets, what the price of their these particular assets ought to be based on the earnings that we see, the growth that we see, and then what kind of a appropriate multiple to put on there.
Yeah, I'll add to that real quick. If you can go back to that slide one more time, Lauren, is that generally in a high interest rate environment, which we are in currently, the Federal Reserve, as I mentioned, has raised interest rates over 300 basis points, and most likely will raise again this month, and perhaps even through the end of the year at slightly lower rates. So we still do think, unless something breaks significantly, and sometimes that happens. What I mean by break is you hear a headline that, again, this is just noise, but a headline that a hedge fund has to liquidate all of its holdings, or there's a currency collapse overseas, or these kind of black swan events that are pretty much insignificant over the long term, but in the short term can signal a change. As interest rates are going up, there is this earnings 16 times multiple compression. It's just a fact that happens in the market. And while that's going on, we really need to pay attention to good companies that do the right things and continue to grow their earnings. That's one way to counteract that. But if we go to the next slide, Lauren, because we want to leave some time for some Q&A. The takeaway again here, as you've already heard me say, is we have been here before. So don't cheat. Don't look at the bottom timeline. But where's 1974's decline of 31.8% on this chart? Where's 2002's decline of 30% on this chart? The blue line, the dark blue line, represents small company stocks, and the lighter blue line represents large company stocks. Despite all of the noise, despite all of these significant events, the Great Depression, Pearl Harbor, the Cold War, the Cuban Missile Crisis, Black Monday, the collapse of the stock market in 1987 that a lot of people remember, Gulf War, 9/11, COVID, where the market, fell significantly just a couple years ago, has been insignificant over the long term. So we've been here before. We know the reasons why we're here. We will get through it 100%. Interest rates, do not go up forever. They do not go down forever, nor do markets. They don't go up forever and they don't go down forever. It's a normal course of the business cycle, and stocks reflect that change in value and the business cycle. Tim, is there anything you wanted to add to that?
Yeah, I have some other things. Let's get to the questions. I did want to talk about the individual bonds and a couple of things you talked about. I could hit it now, or you want me to wait for questions?
Lauren, do we have any questions initially here?
Not yet, but everybody can put their questions into the chat.
All right.
Send a little note so it sends it out to everyone.
Yeah, I wanted to throw in, Tom mentioned earlier that individual bonds are protected from rate drops. And some of you are probably like, oh, I'm watching my individual bonds go down. That's true. You will. We're not immune to interest rates up, bond prices dropping. But the one thing that's important with the individual bonds is there is some finality to them. There is a maturity date, and on that maturity date, the principal will be paid back so long as the bond doesn't default. So in other words, you could buy a bond at 110 with a 5% coupon, and suppose you bought 10 bonds. You're going to get $500 a year while you own that bond. The price of that bond at 110, it could go up to 120, it could drop to 100, it could drop to 90, it could drop to 80. But when it matures, it will get back to 100. And that's something we know when we purchase. And there's something called yield to maturity. And I've probably said this 100 times to people, but it includes the coupon of that 5% that I was just talking about. And on $10,000 or $10,000 purchase, it'd be $500 a year. You're going to gain every year. And then it does assume that it's going to sell at 100 when it matures, and we've got a yield to maturity that's attractive when we buy it, and that's really what drives our purchases on the bonds. Tom also mentioned it's not going to impact your long-term plan, this repricing, and that's what's happening with these bonds and the stocks. Is that we do own an asset. We do own a bond for you guys, or own individual stock. And with the bond, as I mentioned, yeah, we bought it at 110, but we know it's going to 100, and what happens in between is less of a concern with us. The most important thing is to get that 5% return and to get the principal back at 100. So when he says it's not going to impact your long-term plan, that's already known by us. We're in for a retiree portfolio. we're really looking at that income generation, that that $30,000 or $50,000 or $100,000 a year that's being generated by the investment assets. And just because a bond is going down doesn't mean that they're going to default, or doesn't mean it's really tied to interest rates. It could. There are things that could happen. We could have a horrifically bad economy for several years. I mean, that we don't want to dismiss that as a possibility, but our feeling is that these bonds are well capitalized, their balance sheets are in good shape, and then they're going to have the ability to get through this and get through this and pay back the bond. And with the stocks, it's very similar. You own a stock, there's earnings, and as earnings go up and down, the stock price can go up and down. But over the long term, we do expect these earnings continue to grow as they adjust to economies, and that the stock will go as well. So I'll leave it there and see if we have any questions.
Looks like we do have one question, generally around the idea that when we meet and we discuss with you, one of the questions we always talk about is, number one, we want to make sure you have a margin of safety in your bank account. So we want to make sure you have cash available in your checking account, in your savings account, to meet roughly 3 to 6 months of your household expenses, should you need them. And then if you have cash over and above that, you really should consider deploying that cash someplace else. And now is an absolute great opportunity. Not only can we lock in bonds longer term with higher interest rates, we can also buy stocks that are currently, what we believe, mispriced in the market in the short term here, of companies that pay significant dividends, as Tim mentioned, 5, 6, 7. Some of the companies are 9%. So Lauren has asked that I restate the question. The question is, if we have dry powder, is now the time to deploy the capital? And that's that's kind of my point. Yes, we want to make sure we have a sound foundation in your financial planning strategy. We have the cash set aside for emergencies, and as long as that's there, and if you have extra cash, number one, I'd like you to look at a Series I savings bond yielding 9.62%. It's a great opportunity to lock in an inflation adjusted interest rate, and then we can look at inside the terms of your plan, what is the best asset class for you? Should we be adding to bonds? Should we be adding to stocks? So now is absolutely a great opportunity.
Yeah, back to those I bonds. If anybody has any questions, just email Matt or Craig or Tom or myself and ask us. We've got an article on a strategy on how to buy these bonds, where to buy them, what the limitations are. We can explain it all to you. So we do that individually. I do also want to go back to that multiple of 16 times, and again, piggybacking on this dry powder is now the time to deploy. The 16 multiple that we see in the market average right now. There are notes out there, and I don't have them in front of me, but I've seen things. If you strip out the top 8 companies, which would be your higher valuation companies, the market average is actually about 13 times. And honestly, if we dig in further, I bet I can find dozens, if not close to 100 companies that are trading below 10 times earnings. Mm-hmm. There are some companies trading at 4 or 5 times earnings that normally trade at 10 or 12 times earnings. And the idea here is, hey, if you could go back in time and buy XYZ company at 5 times earnings in 2008, would you do it? And the answer is heck yeah, because now we've, in the next 14 years, we've got that multiple expansion from 4 or 5 times up to this normal 12 or 14 times. Plus, we've gotten that growth. And if you've got that time horizon of 14 years, and I think everybody on this call would like to think they have at least 14 years, then you're going to see some pretty significant growth. It may not come tomorrow. It might be coming today. Market's up about 2%, but we think it will come. If history's any guide, we will see a return to strength. It might be 23 or 24 or 25, but we're going to get back there, and we will see that multiple expand for some of these really, really low valuation companies.
Yeah, the market always gives us those opportunities. We think that now is one of those opportunities. And as the title of this slide says, this too shall pass. You know, we have been here before. It's not different in the sense of being here before, having seen significant market declines. I think what we are watching out for is that pivot point, that when the Federal Reserve indicates it is going to stop raising interest rates or slow the velocity of those those rate rises to combat inflation, that is probably the moment that there's kind of an all clear with the economy and all clear in the stock market. But we won't know that. Typically, the stock market will react, the bond market will react well in advance of that, which is why we always counsel we don't want to sell an opportunity, sell in environments like this, which is why we keep an investment plan and asset allocation in place, for all of your portfolios that are consistent with your plan. I'm not seeing any other questions. If not, we'll go ahead and wrap. We just wanted to let you know we recently sent out a client survey. If you got that in your email, or if you didn't get it and would like to participate, it takes about 2 minutes. We would love to hear from you. But one of the initial feedbacks was we heard that what's the best way to get information? And so number one, these webinars, if you didn't join our first webinar, which was kind of recession tips about 6 weeks ago, that is posted on our website and our YouTube channel. But here are some other links that you can get more information from us. And of course, anything timely, time sensitive, we're going to send out an email to you as well. So we do appreciate everybody joining us today. We hope that any of your friends and family in Florida were unaffected by the storms. They're all in our prayers, and just want to say thank you for joining us today.
Thanks, everybody.
Bye, everybody.